Yesterday we talked of horizontal analysis, and we have seen that it is practically the technical analysis. But today we are going to talk on how to analyze this market using the order books that are at our disposal, and that's vertical analysis. Basically, smart money analyze the market vertically. So they have the order book where they can see the contracts, they can see the pending orders, the stop loss levels, and the TP levels. And actually, the important thing is seeing the contracts and the pending orders. When I say a contract, I mean that when someone buys in the market, then there has to be a seller in order for that to be a contract. So the number of completed longs and the number of completed shorts, these are the contracts that are seen on the order book. And so far, order books that we can get access to, we have one the order book, that's the FX on the order book, and we have the book map, we have the COT reports. And COT reports have proven to be effective compared to the others. We have the Rwanda order book. Order book shows 24-hour summary of open orders and positions of Rwanda clients. So Rwanda is basically a Forex broker. So when you look at the order book, this was EURUSD. So price was at this point, and we have a number of longs, number of shorts, and these are the orders. These are open orders, so shorts are many, and here we have pendings. So these are the pendings that are available. So you only see a segment of orders of all the traders in the world, like a segment that are only using Rwanda as a broker. And in the other hand, retail orders do not move the markets. So basically, what the book can provide you with is the pendings that are down here. So if a pattern is formed, and you see that the pendings maybe the pattern is for going long, but you see that there are a lot of buy stops down. I mean, sell stops down here. So market makers can show can go and trade those sell stops and continue with the buy. So that's the only thing that I think that the Rwanda order book can give us. And I remember I used this order book. I remember in 2017, I was doing price action, and I was using this book. So we would put pendings in an area where we think market would go. So, but I did find it less helpful in the trading analysis, especially now that I know the market maker method. And we have the book map now. The book map is the one that you sent me.
Yeah.
See, I've gone through it, and it's a trading platform actually that displays market liquidity. So you can basically see like the number of sellers, the number of buyers, and you can see the increment, you can see the decrement, you can see how these orders are matched. And it has a multi-asset coverage feature. So you can connect to futures, stocks, cryptocurrency. And in the area of futures, they're used where you can see some currency pairs. And so far, I've seen EURUSD, I've seen Gold is there, Nasdaq, and there are a lot of stocks, and the cryptocurrency is actually available. And I think the bookmark can be very useful in the crypto also. So bookmarks, we have the heat map, and you have the volume dots. So these are the volume dots. I remember Mauro did post this once, this volume dots in the charts, and we have this the heat map. So these features allow us to see the limits and the market orders being issued on the exchange. And the limit orders are revealed through the heat map, and market orders are shown through the volume dots. So you see a volume dot, and it's actually the volume dots are, you see green volume dots and then red. So if it's a green volume dot, you see the orders are buys. So 100 buyers match with 100. And here you can see that the number of orders that are going long and the number of orders going short. And in this flashcard, these are the candles. It's actually rough. And this is Euro USD actually. See this pricing. This price is around the quarters, 1.0, 1.02. So this is 100 pips, 100 pips. So you can see that maybe price has gone down from this point to this point, and you think that is a few pips, but it's 100 pips. And actually, these orders they change with the pricing.
Yeah.
So if price is at this point and you see orders changing up here, that means pending orders have been entered. If you see price changing here, that means pending orders have been entered. But the prices changing at this point here, those are the ones that I usually get interested with. For example, yesterday we had the number of longs here. They increased and they were matched. Eventually, the market went up, and here we had pendings going short. And once price reached that area, we saw that EURUSD had come to the area where I wanted to reverse for a peak reset. So for the part of the bookmap, I'm not really sure of how to use it for analysis. I'm still learning it, and I think this will be the next add-on in the BTMM. And so with the features of heat map and volume dots, you can simply identify liquidity patterns and liquidity levels. I see last week I did sell EURUSD, and it was in an area where it was forming a pattern. And when I looked on the bookmap, see the orders were matched, and can clearly see there. And actually those these volume dots, the volume dots that appeared was the red volume dots matching many sellers. And yesterday, when it was buying, the volume dots that were appearing were green and matching buyers. So if you see, yesterday we had a retracement, and before it moved, there is orders for buyers were entered, and eventually the market picked up. And you can clearly see, observe the intention of other market participants by looking on the limits, on the limit order, and you may find the most active price levels, see the market dynamics and the market state, current market state, like see when the market is at certain price level, That means all market orders that are entered at this point are filled. So you can clearly see the orders are filled here, but we have many pendings down there. I guess when I find an edge with this bookmap, I'll host a bootcamp. Huh?
Okay.
And we have now the COT reports. COT, Commitment of Traders Report. See, the COT report shows the number of orders, and it shows the number of orders for the reported traders, reportable traders, which are the commercials and the non-commercials. It's issued every Friday, but it includes data from Tuesday to Tuesday. So the 3 days prior to the release date, the data that is entered, the orders that are entered are not included. So if it's issued this Friday, then the orders that are included will be from today to last week Tuesday. So it reports all open positions in future markets of 3 main groups: the commercials, the non-commercials, and the non-reported. So who qualifies for CFTC reporting? Because the CFTC are the ones that reports, are the ones that file this report, the Commitment of Traders report. CFTC is the Commission for Futures. It's Commodity and Futures Trading Commission, I think. So the ones that actually reported as the one that have to carry a lot of trading. So you have to carry a lot of trading in order for CFTC to consider you in the report. And see, these guys enter at least a contract of 5,000 euros. That's the smallest contract. Now, you need to understand important definitions before we go in analysis phase. And the first definition is open interest. Open interest is the total number of outstanding contracts that are held by market participants at the end of each day. So, total number of outstanding contracts, that means if the buyers are around 30,000, then the contracts are already filled by sellers. So if both parties decide to initiate a new position, so you find one new buyer and one new seller in the market, then open interest will increase by 1 contract. And if traders are closing an existing or an old position, like an old buyer and one old seller, then open interest will decline by 1 contract. And if one old trader is passing off his position to a new trader, then the contract will remain the same. Like one old buyer sells to another new buyer. So open interest will remain the same, it will not change. So if you see increase in open interest, that means new money is coming into the marketplace. And this simply means traders are opening new positions, new transactions are created. The result will be that the present trend, if it's up or down or sideways, will continue. If you see the open interest is increasing and the trend is still going up, then the current trend is still will simply continue because new orders are flowing in. Decline in open interest means that the market is liquidating, people are closing their order, and that this simply means the prevailing price trend is coming to an end. Simply, if open interest is rising with price, the bull market is well supported and should continue. And if open interest is increases with falling price, then the bear market is strong. And if open interest is starting to drop on a still rising price, it simply means the current uptrend is near to its end, and bulls are now liquidating. So they are selling their long position, and it's, you know that if you close your order, basically, if you close your buy, you're simply selling. So price should drop. And if open interest is at a multi-year maximum, so in the part of liquidity delivery, I usually consider numbers like these market participants when they enter longs. Suppose we have around 10,000 market participants, and they have entered longs. It starts by 1, 2, 3. Eventually, all 10,000 will be we have already entered the longs. So no, see the traders no trader is left to transact at that point, because all 10,000 are already in the trade, and that's an area where open interest is at a multi-year maximum. So that simply means the current trend might be near to its end, as there might not be many traders left to transact. They are all in the position already. So that's about open interest. And we have the commercials now. The commercials are the producers, or we call them the hedgers. Hedgers, a group of traders called hedgers or producers. So depending on the market, this group would include mainly the large producers of a given commodity. So if it's a commodity market, so there'll be the large producers of these commodities. If it's cotton, if it's copper, it's gold. So, or it can be financial institutions that hedge against future price changes. So we have these financial institutions who are purely hedgers. So commercial traders usually are most bullish at the bottom of the market and most bearish at the top. See, if the market is buying, these commercials will be selling. The ones that on the other side, they are the hedgers. If the market is selling, then they are buying. And we have now the non-commercials. These are the speculators, the large speculators. These are the consumers now, the buyers of good and the risk attendants. So their main objectives the main objective of speculators is to generate profit from the difference between the current and future prices. And they usually provide higher market liquidity. So when you see the market is buying, that means the large speculators are in buys. If the market is selling, the large speculators are in sales. So we have the large banks, we have the investment and hedge funds.
Okay.
So these guys usually manage money from their clients and are highly profit driven. They are trend followers. And they will be most bullish at the end of the bull, most bearish at the end of the bear. And we have now the non-reportable. Essentially, whoever is left after the classification, they go into this group. So it's basically me and you. retail open position do not move the markets, and we are not eligible to report our trading position to CFTC. So you're not eligible to report every Monday, like to send your report of open positions, or at the end of the day, because our positions do not move the market. We have no impact in the market prices, and we are at most, we are caught in the wrong side of the market. Now, when we analyze the COT, we usually trade in line with the large speculators because they're the ones that are trading in line with their trend. So from this flashcard here, we can see we have the commercials as the red line. We have the large speculators, the green line, and we have the small traders. So you can see these are the large speculators. So if they are up here, the market is long, the market is short, it has reached an area of reversal, the market is reversing, then it has reached an area of reversal, it's reversing, going down. So from this, the open interest usually goes along with the commercials. You can see this is like a multi-year high, and then the open interest is coming to a drop, and then it comes to a drop. We have the COT index here. The index actually is like RSI.
Okay.
So, but RSI, when the price line is at this point, we usually look for sales. But for COT index, it's like it's like the commercials here. So if it's up here, it's a buy zone. You see the market is down. The market will be forming a peak formation low. And here is an area for you to look for sales. The market is up. And if you combine the COT index and this one, can get an edge. Like when you're analyzing using the graph, you simply divide it into a year, like from March to March, and you look at multi-year highs and multi-year highs and lows. Like here is where the low was there, and here is where the high was there, and here is where even the open interest was at maximum. So at this point is where price reversed, and we assume here the number of sellers have come to an end. And even the COT index was showing it was on the buy zone. So these speculators are closing their shorts, so the contracts are decreasing. So as they are closing, they are simply buying. So the orders are decreasing, and eventually the market is reversing. So after you divide it from March to March, you mark these areas, and these are the areas of interest. So if you see that this is the high for the large speculators at this point. So if this line comes to this point, then we're expecting that the number of buyers are over, we're expecting a sale. And if they come to the multi-year low, this will be a yearly low. When they come to the yearly low, then the trend is about to end. The trend is about to end. But also we have the numbers. So you can view using the graph or the numbers. And in the numbers is on the CFTC website, on the Chicago Mercantile Exchange. You go to the short format, get it. So on the numbers we have, this is how it appears. This is British pound. These are the future positions for this date, 24th of March. So we have the non-commercials and the commercials, the longs, the short, the spread, the difference. Long, short, the long, short. So for the commercials, we have long shorts and we have total longs, total shorts. And we have the non-reportable here. Here we have the open interest, but we have the change in open interest from last week. So this was 24, this was 17. So we have seen the number of orders have decreased. Now you come to look on the non-commercials. We have changes. So it's 46,000 as the number of longs, but then this is changes from last week. From the previous week, here is we have seen the number of longs that they have closed. They have closed around 10,000. The number of shorts that have been closed is around 2,000. So basically, they are closing the longs, and if the market was on a bull trend, then you simply know that the market is about to come to a reversal. And if your conferences are telling you that the market will reverse, then eventually it will reverse. See, they are closing longs, and these people are opening longs. They're basically selling, the commercials, and they are closing their shorts. And we have the percent of open interest. Like 61.8% are longs. If the market is long for the commercials, if the commercials are long, then the market should be short. And if the large speculators now are long, the market should be long.
So when analyzing the report, which do we concentrate more on? Like who are the dealers?
The large
concentrate on all of them.
No, the large
non-commercial.
Yes. Okay. I usually concentrate on the large speculators and the open interest.
Oh, okay.
So see this graph is very rough. Yeah. You can see several highs here. Like we had this like a monthly high, but this was a yearly high, and this is where the large speculators came again. So the contracts around 40,000 is where the contracts did end. The market was short, then came long, short, then they came again at this point. So you see the yearly highs. These are the ones that matter for a big reversal when you're analyzing the graph. And you can see when the open interest is around those points, is around the multi-year high. So we have the 12-month extreme net long in the commercial position. So here we are looking for commercials. So this is around September 2018 and August 2019. So September is here, August is here. So this was the 12-month extreme net long. Reduce risk on shorts. Start looking for buys. And we have the net short commercial position. This is around March 2020. So here we have it. The commercials were net short. So look for short intermediate downside correction, like these people are going to buy, so the market will come to sell. And we have the net long commercial position. Those are the ones that have not reached the 12-month extreme, but you see there's high here and they are going down, high here though. So like at this point we have this is the high, the 12-month high, but this is also a high. So this is simply net long.
Okay.
So look for positional swing longs. Yeah, if they are in net long, that means they will come to sell. So you should be looking for swing longs, right? This when you're analyzing the commercials, it's really confusing.
Yeah.
Now I use the numbers, okay?
Yeah. Okay.
And I have the spreadsheet for that. I have the spreadsheet where I every week I feed in with the numbers, and I can clearly see, and I can clearly see if the number of longs have been increased or the number of shorts, and I usually look for the net balance, net position balance for large speculators. Are they net long? Are they net long or are they net short? And this goes along with the market structure. So if they're net long and the market structure is bullish, then I know that this trend is still going up. For example, for pounds, they are net short from March, I think, when the market started selling. They become net short. Yes, they see from this when I was taking this, this flashcard, they are decreasing the number of shorts. I mean the number of longs, the large speculators, and they became net short. So it's around 50,000 here right now. So they were net short, and the market was showing the bear market for in the daily time frame was there. So I was very sure of the market was falling. And if I analyze the COT and there is a news release coming, and when my buyers for the technicals, when I analyze it horizontally, I see that my buyers goes along with the net position balance for large speculators, then I'll be that's a high probability setup for me. So start thinking about trend change if the speculative position turn net long to net short, net tend to net long or to net short. So speculators will be net long if their long position exceeds short position, and they'll be net short vice versa. So if the speculators turn to net long, the prices will climb. So you see a very good bull market. And for a bear market, it will be the same if speculators turn to net short. So the COT report is not designed as a market entry tool. It simply gives us the supply and demand of important market participants. And we need to combine it with the technicals. And it's usually not suitable for day traders. See, if you are a position trader, if you're a position trader, you can simply use COT and support and resistance on the monthly, and you are very okay. You'll be winning. Yes. Now, we have learned many things.
Yeah.
And we come down to the 4 phases of focus, and here we simply remind ourselves of what we learned and what should we focus on when we're trading the markets. So all well thought signature trades have 4 phases of focus. We have the before entry phase, we have the entry phase, we have the reversal, and the take profits. Now, on before entry phase, this is the part where we do our analysis. Now, let us remind ourselves, what do we look for? First of all, look for higher time frame manipulation, like the market structure on the monthly and the weekly. Look for seasonal move if there is a seasonal shift. We combine it with the COT, because when the shift occurs and the COT also change from net long to net short, then I know that this shift is this trend is on. And you come back to the daily, and therefore also to look for the market flow. Also, the position of EMAs in the higher time frame is very important. On the R4, you look on the harmonics and the TDI. On the R1, you look on the levels, the ADR, and the quarter points. But also, we look for any available information, exchange information on Forex. The volume, the ratios, the order book, important price levels, the patterns, the trend. So basically, this is what we look for. Any available exchange information on Forex. That's before entry phase, and you need to have an anticipation. So you need to have a directional bias. You can be correct or you can be wrong, but you need to have a view. See, every trader has to have a view. See, the course that I am taking on the part of Forex, so on the part of assets, the assets, and there we came to the market participants, and we talked of the Forex trading. See, all that part, the one that was teaching was the head of trading desk of Stanbic. So it was practically a dealer. And he says that in the market, say it's a Forex market, it's equity market, it's bond market, a trader needs to have a bias. He needs to have a view. Because once you're maybe in a trading desk in a bank, so they ask you for a view. Where do you see oil prices going? So your view gives them their bias. And if you are correct, say it. If you're correct, then you'll be a hero. But if you're wrong, then sometimes they may fire you. Because we have Kenya Airways. Kenya Airways went into a forward contract with oil company when oil prices hit around 100. So they were anticipating that oil prices would rise, simply rise to 200 or 300. So they entered in a forward contract that for the next I don't know, 3 years, they'll be buying at a price of 120. But then, at that point in the monthly time frame, oil prices created an area of resistance, and they were falling. And as price was around 75, the contract now become executed, and the price of the oil barrel is around $75, but they were buying at 120. And as price was going down, they were simply buying at 120 because they entered the order. They entered the contract. And basically, the advisor there was wrong, and they did fire him. But if only he was right, if only price climbed to the 200, then they would be in a very good contract. They would be buying low. So a lot happens in the markets. Even those institutional traders, they may be wrong on their bias, but you need to have a view. You need to have a view. So after having your view, now we come to the entry phase. The entry phase is when the market now is open and it's real-time market. So we look on the 15 minutes manipulation. Now we come down to the 15 minutes time frame. And here we look on the Asian box. Is it not blown? We look for the stop point. Is it going as anticipated? The London pattern presented itself? If the London pattern presented itself, do we have the entry confirmation, the 5 and 13 crossover? And is the timing correct? And here the timing is only London or New York. And they usually take trades until 1700. So above that, if there is any news, then I take a trade. But above that, I usually don't take a trade. Always trade in line with the peak. So if the peak is low, you look for buys. If the peak is high, you look for sells. And you should remember to put your stop loss. That's one thing you should always remember. Now let us remind ourselves from the trades that we have learned. We have the peak trade, which is around the bull tracer, like what we have here. We have the ID 50 after the peak, the first pullback towards the 50 EMA, after 13 and 50 crossover on the 15 minutes. That's the ID 50. We have the safety trade, where we see a stop and toward the peak and pattern forming around 200 EMA. This is basically type 2 London pattern. This is basically a safety trade. And we have the blueberry trade. We have when price broke the blueberry and come for a retest. This was the first entry, and we have it here again. So that's a blueberry trade. We have Emma combo trade, where the EMAs are close to each other and CDR is forming a pattern for you to trade away from the peak. We have peak resets. Peak resets are also peaks. So this is the blueberry. This was the first bounce, and here we have the second bounce. You see this is a peak, and our entry is there, and pattern around session changeover. And this was also a peak reset around the blueberry. So here is the first day, and this is the second day. So the peak trade and the ID 50. We have order block, a bullish order block there. There is a return on the order block. So this was a whole block of orders. So the return to the order block, and then price moved away from it. We have a bearish order block here, the green candle. So market returned to it and then moved away from it. We have the breaker block here. So this was the first high that was formed, and this was the breaker. And eventually price came to retrace to this. It's a buyer's remorse and then continued. We have the propulsion block. Here we had another block. So the market came to retrace to this point. We also had another block here. The market came to retrace. So this became a propulsion block. So a retracement to this point was an area for entry. We have the last step broken as the mitigation or the breaker block. So we had another block here, and we expected for price to retrace to this point and continue up, but then it break it and then came for a retest again. So this is the last step broken. And we have other entries around the station zone area, large quarter point, half point entries. We have the equilibrium, premium, and discount markets. So these entries are usually supported in the other conference, since most we are looking at indicators. and we're not really sure if price will interact effectively with the indicators unless other conferences are available. So that's the entry phase. Now you're already in the trade. Now we come to the part where the dealer will play with your fear. You need to trust the process. That I know this is a peak trade, and this is an area for peak research. So the market will eventually go in my side. So the part of reversal, market makers may fake a reversal and check your emotion to get you out of a good trade. So know which is a real reversal and which is a fake one. So you don't see 3 intraday levels. Then you see a retracement. That's a simple retracement. The market will continue going in that direction. So that's a fake reversal. And the real reversal is when you see now 3 intraday are over and the market is coming back to rest. So that's a real reversal. Or maybe you see 3 levels on the hour 1 time frame or the daily, and you see the market is about to reverse. That's a real reversal. Other are just a retracement and the market will continue. And we have the last phase, the take profit phase. Always have your target. Don't simply enter your orders and wait for the market to swing and you don't know where you're closing. Always have a target. And common TP levels are the ADR levels, the blue tracer, the quarter prices, and the EMAs. These are the common TP levels for MPP traders. And TP also depends on an area of entry because someone can have a 50 pips take profit, but his entry was early compared to someone who has a 40 pips TP. So a 40 pips TP may have entered the market 10 pips late. So for swinging, you need to swing if you have trade the peak, or maybe a safety trade. But the peak trades are usually good for swings. But scratch out rules are applied. Here is when you see maybe price has bounced around 200 EMA on the daily time frame, and you see that the market might reverse. So scratch out rules might apply. You may scratch out and then look for a reversal. So when you are swinging, after the dealer has completed 1 times ADR, that is where you move your stop loss below the entry or above the entry. So you break even there and you simply wait for price to complete all 3 times ADR. You don't trail your stop after that. So you need to master these 4 phases of focus in order for you to be successful. It's not only the analysis, but also the entry, the part of reversal, the part of having targets. Sadly, most traders spend all their time on the entry rules of a trade. Most of them. See, I have students who wait for my analysis. They don't do analysis and enter in the market, focus on the entries. And it's just that. So suppose I don't send analysis maybe on Sunday. Some people may come to my inbox and, why are you not sending and all that? Sometimes I get so busy and I don't do that analysis on the weekend. So it's usually sad for me if I see someone doing that. And I'm the only one who sends analysis on the group. Sometimes people send, but it's very rare. And I have common students there. I know this one would send, this one would send, but never this one. Yes. So let's finish up with the rules now. Rules to profit. So 4 phases of focus should be mastered. And the only way you master them is you need to mark up your charts every day. See, you mark up, you know you have anticipated, you have your entry, you simply mark up. Anticipate stop and zones and entry zones a day before it happens. And show up to the market every day, no setup, no trade. So it doesn't matter if it's a Monday or Tuesday or it's a Friday. Show up, no setup, no trade. And only trade when the dealer has hit the stops. Learn to be highly selective. And to be highly selective. Don't simply force a trade. And stop chasing trades once you have missed an entry. Trade on the basis of a close candle.
Okay.
So always wait for a close of a candle in order for you to enter, preferably with multiple confirmation. And sometimes rather than aiming to make many pips per day to achieve your income targets, you can simply aim for a few pips and ramp up your contract size. But see, the contract that you are entering should not interfere with your emotions. See, if you have emotional, your emotions are not stable when you are in a trade, it's only because you have entered a lot size that affects your margin or affects your capital. That's why you simply look at a trade every 5 minutes and all that. And you need to control your fear and greed. That's the part of the emotions, and that's the only way for doing that is to use a contract style that do not interfere with your emotion. And do not take trades using your phone. Never do analysis using your phone, because you will not see many features. There are no quota prices, there are no ADR boxes, there are no. See, never do analysis using your phone. And I prefer if you look at your entry using your PC and you place your order using your phone. And always remember, it's okay to have losses. So it's okay that your entry has hit your stop loss, as long as more of your trades are in the money than out of the money. So the aggregate should be positive. The part of risk management and money management, I usually don't teach this part. The only thing that I tell you, use a contract size that do not interfere with your emotions. That's the only way you manage your money, you manage your risk. And at the end here, we have the SWOT analysis. Here we look on the strength, weakness, opportunity, and threat analysis. I think you should do this SWOT analysis maybe after 3 months of trading. Now you come to look at your strength. What are your strengths? You have maybe above average knowledge about the market. How to place orders. You know how to navigate the MT4 platform. That's your strength. You have gone through a good education. Maybe you have good leverage with the broker. You have a capital. You're not afraid to take a hit. You're goal-oriented. So you come and look on your strength. You come to look on your weaknesses. What are my weaknesses? Am I feeling pressured to trade urination? Is it difficult for me to break my old habits? Like, I've been taught this, but I have this old habit. I simply go back to that. Am I over trading? So you simply, you look on your weaknesses, you look on the opportunities now that you have. Like, you have the opportunity to trade the London session. Like, your time zone is favorable. You have an opportunity to review the course, or you have an opportunity to go through the education. You have opportunity to study and be able to visualize patterns. with one look at the chart. So you have an opportunity to review the course materials. You have an opportunity to do homeworks, to mark flashcards. You have the opportunity to learn patience. So you need to plot down the opportunities that you have and the threats. Are you distracted with other causes? You have too much distraction from other causes. This is seen this to many people. Even a few of my students, seeing that they are distracted from other causes. You're too eager to make the money, and you're only distracted from other causes if you have not done the homework for this cause.
Yeah.
Yes. Are you not sticking to your goals and trading plan? What's the threat? Like, I can go back to my old habit when I experience a loss, or is the capital a money that I cannot afford to lose? So once you plot, once you know yourself, the strength, the weakness, the opportunity, the threats that you have, then you can clearly have a way forward on how to tackle this. And SWOT analysis is very important. I usually do it for myself once a year. I have my spreadsheet for my own evaluation. And that marks the end of the course.
Okay.
So I expect you to do more homeworks and mark as many flashcards as possible and take trades. Need to be taking trades. That's the only way you get to understand this. Need to take trades.